Hi everyone. IGCSE accounting, the topic principles of accounting. The accounting principle. The accounting concepts are the rules that are applied in recording transactions and preparing the income statement and statement of financial position. This is a mind map of basic accounting concepts: prudence principle, business entity principle, accrual principles, consistency principle, historical cost principle, duality principle, matching principle, money measurement concepts, materiality concepts, going concerns. First principle, matching principle, it is also known as accrual concepts, requires all revenues and expense to be taken into account for period in which they are earned and incurred when determining the profit or loss of the business. The business or loss is the difference between revenue earned and expense incurred, and not the difference between the revenue received and expense paid. For example, rent still owing at the end of the year should be included in this year's expense. Business entity concept. Business and owners are two separate things. Only those transactions which are related to business can be recorded, not the owner's private transactions. Example, the owner buys himself groceries will not be recorded. Consistency principle. According to this convention, accounting practice should remain unchanged from one period to another. For example, if depreciation is charged on non current assets, according to a particular method, it should be done year after year. This is necessary for the purpose of comparison. For example, keeping the percentage rate of depreciation the same every year. Duality principle. Every transaction will affect two items in the business. This is represented by both a debit and a credit entry in the ledger. Every business prepare ledger account. The ledger account is based on this principle. Going concern concept. Assumption that the business is going to continue in future. A business should be a continuous process. It should not close in the near future. Historic cost concept. The historic cost principle requires that all asset and expense are initially recorded in the ledger account at their actual cost. Actual cost means list price minus any discount given by the supplier. Materiality concept. This concept implies that you should not waste time recording transactions that are trivial, involving very small amount of money. For example, some item, stapler, paper clips, etc., are not considered non-current assets, though they may be used by the business for a long period of time. Rather, their costs are written off at one against profit in the period they are bought. Money measurement concept. Only transactions that can be expressed in monetary terms are to be recorded. For example, quality of product, efficiency of management will not be recorded. Prudence concept. Assets and profit should not be overvalued. Liabilities should not be undervalued. Profit or gain should not be considered until it realizes. Loss should be considered immediately. For example, provision for doubtful debts, provision for depreciation, and inventory is valued at lower of cost or net realizable value. Realization concept. Revenue is considered when goods are sold either for cash or credit, namely, the credit customer accepts the goods or service and the responsibility to pay for them. For example, a sale is considered to be realized when a customer takes ownership of the goods or service, regardless of whether money is received straight away. Thank you.